The monthly jobs report for July is out, showing U.S. employers added 187,000 jobs. The unemployment rate ticked down from 3.6% to 3.5%. This report follows the Federal Reserve's decision to resume interest rate hikes to cool inflation and that hot labor market. Meanwhile, our country's credit rating was downgraded for the second time ever. To read more into all of this, I want to bring in David Stryzewski, CEO of Sound Planning Group. David, welcome. Good to see you again. So another good jobs report, albeit lower than expected, but still strong. Healthcare jobs led the way, followed by social assistance. What's your read on it?
Well, great to be with you here as well. This is an important thing for us to be looking at, but just a couple of things to put in perspective here. We're looking at hindsight right now. So this is last month. And also, if we look at numbers that have come out in previous months, we need to understand that they've actually been revised back down even lower to the numbers that we had before. So, I take all these kind of with a grain of salt. After I went through that class in college that talked about statistics lie, specifically that day in economics. And so, when we look at what the actual numbers are here for employment, it's interesting to understand that just only 3 quarters ago did we get up to the pre-pandemic levels of where the jobs are. So these numbers are kind of misleading. Statistics can lie. And so, it's important to also understand that there's a significant difference between the establishment survey and the household survey. So the establishment survey just asks employers, hey, do you have new employees coming out? So there's the 187,000. Now that's both full-time and part-time workers. When you look at the household survey, little has changed from the last month to this month. Ironically, there's not even a real number that's been generated, but that's just asking people, are they working or not? So they could be working 2 or 3 jobs, which is what we're actually seeing right now. A lot of people are working part-time in order to make ends meet. So I think that it's really important that we understand, how is the average consumer, the average family doing? I do not see a robust jobs market. I do not see this as strong as a lot of people are indicating, because let's just be honest here. People are taking a second or a third job right now. The good employees are getting employed. Many people out there today are becoming less adequate for the positions of the future as AI and technology are really driving that forecast.
Yeah, you're right. Well, the jobs report is strong. Unemployment is low, but so is the labor force participation rate. Inflation is headed in the right direction, but it's still high. Let's not forget about the compounding inflation over the last few years, reaching a record high of 9% just last year. Several banks have failed recently. It's more expensive to borrow money. Household debt set a record high of more than $17 trillion recently, and gas prices are going up again. And according to a new CNN poll, if you look at this, compared to last year, most respondents, 54%, now say they trust Republicans in Congress over Biden, 45%, to deal with the major issues facing the country today. And that same CNN poll shows that despite positive economic news, aka Bidenomics, 51% say they think the economy is still in a downturn and getting worse. Also, Fitch downgraded the U.S. credit rating this week, citing a deteriorating economy and governance. This has only happened one time ever before. Now, the White House blames Republicans for undermining Biden's economic agenda, which they say has led to the strongest economy and recovery globally. What's your expert analysis on the White House's narrative and what people are seeing and feeling?
Man, you just asked an amazing question right there. So first, let me just note, I try to take these questions as being financially agnostic. But when political science affects my science, which is economics, I need to have an answer. We need to have responses for what's going on here. So, first off, Biden economics is a complete failure. It is not capitalistic whatsoever, which is the reason why our nation has become successful and has sustained in the way that we have. And so it's actually really opposite of that. So, when we look at a lot of this data, just understand, if we look in the rear view mirror, it's a really weird way to be driving the car. In the rear view mirror, hey, numbers look okay, coming down, et cetera. But if we look at all the forward-looking indicators, we're recognizing a very different picture. Additionally, when we look at some of that data, just like you said, this is chain-weighted data. When they print 40% more money from 2020 through 2021, and they just flush this economy full of liquidity, guess what happened? bubbles are generated, stock markets go up, housing markets go up, everything does so well. But when they're talking about our CPI data and everything, they're not taking into account probably the 40% inflation that we've had since 2020. I want to encourage people, if they sit back and they look at their personal CPI, your personal costs and expenditures, what you actually spent money on pre-2020, post-2020, 21, 22, we've got several years worth of data that we can actually track. I guarantee you that the numbers are very different than what the CPI numbers ultimately are looking like right now. So, your personal CPI is important to be able to understand, but just also look at this, the political elites right now in our economy, I think that they're looking at things very differently. Why? Well, many of them are very wealthy. Okay. And so if you've got a ton of money, some of this stuff affects you. Maybe you've made a few different decisions since the recession's kind of begun, which, by the way, last year in July, we had 2 negative quarters in a row. That would define a recession according to the way that I was raised and taught about this stuff. But that's a side conversation. The average consumer today, I think, is a really good way to gauge how is our economy doing. We have record credit card debt, like you just mentioned. We've got a lot of people that are cash strapped right now. They're not out buying their first home. The young people today are very concerned and nervous about their future as they're seeing a lot of this change. But I think that, the low income and middle class are suffering considerably right now, according to Biden economics. And, a lot of that comes from their fossil free agenda. That they've done. And so, of course, supply and demand is basic economics here. So you could either affect supply, which is what capitalism tries to do, make it cheaper, make there be more of it, where this more Keynesian approach to what's going on in our economy is trying to curb demand, meaning they're trying to hurt you as the buyer, as the individual, by making interest rates more expensive. They have to do it because you've got so much money sloshing around this economy right now. But, we're looking at, we canceled U.S. oil permits and exploration. We did the same thing for metal miners. By the way, all this Green New Deal stuff is going to take, these copper and rare earth minerals, which we've not been expanding our supply of, but the demand has certainly been going up. At some point, those things have to intersect, and you see imbalances here. So I personally am expecting very significant challenges as we move forward in the future, even though people like Jamie Dimon today just came out and said that he doesn't see a recession going forward. I actually see something that's more like a rolling recession, not just some simple downturn. There are too many things that have been messing with the very fragile ecosystem, which is our economy. Now, it's resilient, but it's also fragile. And when you get interest rates that pop up like this, you change the housing market. You change the way that credit works. You change the way that employers borrow money, making the cost of capital so much more expensive than it was before. Our economy has just been flipped on its head. And then we've got new policies that are coming out right now, like the Inflation Reduction Act, which is a clever title, but we have 87,000 new IRS agents. That's how we're going to reduce the inflation, is by getting more tax money. The average person sitting here going, well, wait a minute, 87,000 new IRS agents. Was I doing something wrong? There's only 72,000 bank branches in America. So 87,000 new IRS agents? Why would that be specifically? I have a lot of questions right now without a lot of specific answers as it relates to what, the current party in power has been doing. But ultimately, hindsight's going to be 2020. And I think that if we're looking back a few years from now, we know that you reap what you sow. You don't plant corn and expect orange groves to be showing up. We're going to have more challenges ahead of us. So, it could be that AI is valuable in creating, more production per employee, which, if you have higher wages for the right employees, that's going to become very important in this new economy ahead. But lastly, getting to your thought there about the Fitch downgrade. I mean, this is exactly what happened in 2011. I mean, I was saying this, I've been saying this for more than a year right now, that we had this debt ceiling issue that was coming up. But what's surprising to me is that Fitch came out with this reading not between when the negotiations were taking place over the debt ceiling. We exceeded that debt ceiling in January this year and didn't get this thing figured out until almost July. there's about 6 months that occurred where it would have been really probable to say, hey, you know what? We got political stalemate right now. We've got higher debt to income ratios. The United States is not as peachy as it once was. But here's an interesting reality. There are nations right now in the earth that are now more creditworthy than the United States. There are companies in the United States that are more creditworthy than the United States. This, to my opinion, is blood in the water for our adversaries as we're seeing challenges take place with the BRIC nations. They want to trade with one another. They're de-dollarizing. They're not buying our treasuries. I mean, China has literally significantly reduced their treasury purchases. And of course, what they're doing right now is they're buying hundreds of tons of golds openly. Why would they do that? China doesn't do anything unless they want you to see it. I think that we are being set up right now for what I hope does not occur, which is like a World War III type of scenario. And I don't want to be a big doomsdayer. I'm just saying there's a lot of stuff that's adding up right now. Very, very, very scary. Right. And China's playbook looks like they're exactly preparing for that.
Well, David, for our viewers, why don't you just sum up what the disconnect is between the White House, the message from the White House, and what the average American family is feeling? Where's that disconnect? Sum it up for our viewers.
Okay, well, here's one. Let's just even talk about wage inflation, which is something that the Fed looks at a lot. Okay, so if you look at wage inflation, they think, well, hey, wages are going to go up because an average employee is thinking into the future, and they think, hey, UPS just negotiated a deal for 10% more CPI each year. Okay, so every employee is looking at the world and saying, I need 10% more each year. No one's thinking forward on that. People are looking at their day to day, and they're recognizing if you're out doing you're up, you're down. I need more money. And so the big powers that be are looking at Phillips curves and things that really have no bearing on what's actually taking place in individual lives right now. You go to the grocery store, it's more expensive. CPI went down because, gas lost 50% of the cost of what it was just a year ago. Well, it's now up about 25% in the last quarter, and I think it's heading up higher. I think we're about to see much more inflation occur, but this stuff takes time. Again, for things to grow, it takes seed time and harvest. And ultimately, the things that are growing right now are not positive for the world. So this is, again, why my personal thesis is that I believe that we're going to see more of a rolling recession, as there are a lot of challenges and headwinds kind of taking place right now as we're moving forward into the future. So the next 12 to 24 months are likely to be really, really, really challenging. And, the government, the powers that be, they can spin this information. Again, statistics can lie. I can give you a positive report off the same information. I can give you a negative report. I just want to be a realist. I want to talk about how things are impacting the bottom line. And I think that that's the part where the disconnect is. People, they're not looking at how people are actually doing. We've got more debt. We've got, concerns about the future, your family. I mean, I've got 5 children. What's the world going to look like for them as they get older right now? The cost of everything has gone up, and it's not going back down. One last point on this is that capitalism makes things cost less, right? And so if capitalism was reducing the expenses of everything because it's making it more efficient by 5% per year, just using simple math, and inflation was at 7 because the print and spend concepts that are going on here, well, then you have a positive inflation of 2. Well, wait, capitalism is actually reducing it, but inflation might be 7, and that gives us a net of 2. We're seeing more factors like this. And so it's kind of the shadow statistics that are important for us to be looking at right now. Like 1 + 1 = 2. Don't just look at the headlines.
Yeah. All right. David Stryzewski, good insight. Sound Planning Group. Thank you, as always.
Thank you.